Right now, as you are watching this video, one of the greatest wealth transfers in modern financial history is unfolding in real time. And most people, most ordinary, hardworking people, are going to completely miss it. Not because the evidence isn't there, not because the data is hidden, but because the mainstream financial system has spent decades conditioning you to ignore silver, to dismiss it, to treat it as the forgotten little brother of gold. And while they were busy doing that, while they were pointing your eyes somewhere else, the most powerful supply-demand crisis in the history of this metal was quietly building underground, and it is now erupting to the surface with a force that no paper contract, no algorithm, and no central bank can stop. Let me give you the numbers right now, because this is not a feelings conversation. This is a facts conversation. Silver started the year 2025 at $28.92 per ounce. By the end of that same year, it closed above $72 per ounce. That is a 107% gain in a single calendar year, the best annual performance for silver since 1979, nearly half a century. And then in January of 2026, silver smashed through $100 per ounce for the very first time, climbing to an all-time high of $121.62 on January 29, 2026. As of today, March 2026, silver is trading around $88 to $90 per ounce. And you might be sitting there thinking, did I miss it? Is the move over? Let me tell you something clearly. You have not seen anything yet. The structural forces driving this are not short-term. They are not speculative. They are mathematical, geological, and geopolitical, and they are only accelerating. Let's talk about what's actually happening under the surface, because the surface price is just the symptom. The real story is the foundation, and that foundation is cracking in ways that should make every serious person take this metal with the utmost urgency. The global silver market has now been in a structural supply deficit for 5 consecutive years. 5 consecutive years where the world consumes more silver than it can mine and recycle. According to the Silver Institute's World Silver Survey, the cumulative shortfall between 2021 and 2025 alone totals approximately 820 million ounces. 820 million ounces that the world needed and could not get from new production. That is nearly an entire year's worth of global silver mining output. Gone, absorbed, consumed, and here is the terrifying part for the paper market. Those ounces don't come back. Once silver is used in a solar panel, once it's embedded in an electric vehicle circuit board, once it's deposited inside an AI data center's electrical system, it is gone. It is not recycled at anywhere near the rate of gold. It is industrial consumption that is permanent and irreversible. Now, let me walk you through where that demand is coming from, because this is critical to understanding why the deficits will not only continue, they will deepen. In the year 2024, solar photovoltaic manufacturers alone consumed 232 million ounces of silver. 232 million ounces from solar alone. Compare that to just 60 million ounces in 2015. That is a near quadrupling of solar silver demand in less than a decade. And global solar installations keep setting new records every single year. Every panel that goes up on every rooftop, every solar farm that gets built across the American Southwest, across India, across Europe, across China, every single one of them uses silver. There is no substitute that performs at the same efficiency at commercial scale. Silver is the most electrically conductive metal on planet Earth, period. And the solar industry, by law of physics and economics, will not stop building. Then you add electric vehicles. EV-related silver demand jumped an estimated 20% in 2025 alone. And Oxford Economics, a major independent research firm commissioned by the Silver Institute, projects that EV vehicles will actually overtake internal combustion engine vehicles as the primary source of automotive silver demand by the year 2027. By 2031, EVs will account for 59% of all automotive silver consumption. Every electric vehicle needs silver in its sensors, its high-voltage wiring, its advanced connectors, its power management systems, and its charging infrastructure. As vehicles electrify, silver intensity per vehicle continues to rise. The car of the future is a silver-consuming machine, and the world is building hundreds of millions of them. Then you have artificial intelligence and data centers. Total global IT power capacity increased approximately 53 times from less than 1 gigawatt in the year 2000 to nearly 50 gigawatts in 2025. Every data center powering the AI revolution, every server rack running the large language models, every cloud computing facility storing the world's data, they all use silver in high-efficiency electrical components, precision contacts, and thermal management systems. This is an entirely new demand vector that did not exist at scale a decade ago, and it is growing exponentially. And then there's 5G. The global build-out of 5G telecommunications infrastructure requires silver in every antenna, every base station, every connected device. Industrial demand for silver reached 677 million ounces in 2025, according to the Silver Institute data, making industrial use the single largest and most stable component of the entire silver demand equation. Industrial demand is not speculative. Industrial demand doesn't sell when prices rise. Industrial demand is locked in by the laws of physics and the mandates of the green energy transition and the digital economy. And that is precisely what makes this moment in silver so extraordinary, because the supply side cannot keep up. Let's talk about supply, because here is where the true crisis lives. Global silver mine supply has actually declined by 7% since 2016. 7%. In a decade where demand has exploded across solar, EVs, AI, and electronics, the mines are producing less silver, not more. And why is that? Because 70 to 72% of all silver produced in the entire world comes as a byproduct of mining other metals: copper, zinc, lead, gold. Silver is not the primary target. Silver does not set the drilling schedule. When a copper miner decides whether to invest billions in a new project, they are making that decision based on copper prices, not silver prices. So even when silver prices rise dramatically, and they have, the supply response is slow, constrained, and completely inelastic. There are permitting delays, there are capital intensity challenges, there are declining ore grades at existing mines, there are no major new primary silver projects ready to come online in the next 2 to 3 years that can meaningfully move the needle. JP Morgan's commodities team, in their 2026 silver outlook, confirmed that the market ran in fundamental deficit basically since 2021. They describe supply deficits of 100 to nearly 250 million ounces annually, enormous in the context of a market where total mine supply is only around 850 million ounces per year. Let that sink in. The annual deficit in some years represented nearly 25% of total mine production. You cannot sustain that kind of gap without a massive repricing of the asset. And that repricing is happening right now in real time. But here is the key insight most people miss. It is still in its early stages. Now I want to talk to you about something that most of the financial media is barely covering, and it is the single most important geopolitical development for silver in the last 20 years. On January 1st of 2026, China, the world's largest silver producer, placed silver under an approval-based export licensing regime. Think about what that means. China has effectively reclassified silver the same way they classify rare earth metals, as a strategic resource requiring government permission to export. This is not a small policy tweak. This is China publicly acknowledging to the entire world that silver is no longer an ordinary commodity. It is a critical mineral, it is a strategic asset, and by restricting exports, China has fragmented the global silver market into regional islands, Asia, North America, and Europe, each fighting over whatever physical metal they can secure. The rest of the world can no longer rely on Chinese refined silver to plug its deficits the way it has been doing for years. And it gets deeper than that. Because simultaneously, London Metal Exchange inventories were draining at an alarming rate throughout 2025. According to Goldman Sachs analysis, tens of millions of ounces were shifted from London to COMEX vaults in New York in early 2025 amid tariff fears, leaving London stocks critically thin. Lease rates in London spiked toward 39%, which in the precious metals world is a 5-alarm fire signal of extreme physical scarcity. You don't pay 39% to lease a metal unless you are desperate for it. These are not the conditions of a normally functioning market. These are the conditions of a market in the early stages of a genuine physical supply crisis. Now let's bring in the monetary dimension, because silver is not just an industrial metal, it is money. It has been money for 5,000 years. And in a world where every major government on the planet is running deficits, printing currency, and monetizing debt, the monetary case for silver has never been stronger. Gold has now surged past $5,000 per ounce, up approximately 67% in 2025 alone, and JP Morgan has raised its gold price target to as high as $6,300 by end of 2026, with an upside scenario of $8,000 being discussed. When gold moves like this, silver historically follows and then dramatically overshoots. That is the pattern. That is the centuries-long pattern of how these two metals behave in monetary crises. Let me give you the most important ratio in precious metals right now, the gold to silver ratio. This ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. For most of recorded human history, under the Roman Empire, under Byzantine monetary systems, under early American coinage law, through the Coinage Act of 1792, this ratio was fixed between 12:1 and 16:1. The United States legally established it at 15:1 in 1792. The geological reality supports this. Silver is mined at approximately a 7.88 to 1 ratio relative to gold in terms of annual output. The Earth produces roughly 8 ounces of silver for every 1 ounce of gold. Yet the current market prices silver at approximately 57 to 60 ounces of silver per ounce of gold. That is still a massive historical anomaly. That is still telling you that silver is significantly undervalued relative to gold, even after its 147% surge. In April 2025, at the most extreme point, the ratio exceeded 100.1, meaning silver was trading at its cheapest relative to gold since the year 2020. Those investors who recognized that extreme and acted on it doubled the returns of gold investors within the same year. But the ratio still has enormous room to compress further. A move back toward historical norms of 30 to 35 to 1, which is where the ratio spent much of the 20th century, combined with gold at $5,000 or $6,000 per ounce, would imply silver prices of $140 to $200 per ounce. Some more aggressive analysts, accounting for the unprecedented industrial demand dynamics and the monetary reset environment, are projecting silver at $300, $400, even higher in the years ahead. Gold Silver's Alan Hibbard stated publicly that he would not be surprised to see silver increase by over $100 per ounce in 2026 alone, targeting $175 or higher. And here is something that almost nobody is talking about. Silver-backed exchange-traded products reached $40 billion in total valuation by mid-2025, establishing silver as a genuine global safe haven asset class. Physically backed silver ETFs absorbed 134 million ounces in 2025 alone, 134 million ounces taken off the market and locked into vaults as investment demand. This is real physical demand, removing real physical metal from the available supply pool. And this is on top of an already deficit running market. When retail and institutional investors decide simultaneously to add silver as a monetary hedge to their portfolios, the available inventory of freely traded silver becomes extremely thin. The Silver Institute noted that small increases in demand can now lead to disproportionately large increases in price because the physical market is so tight that even marginal new buying creates outsized price moves. This is the setup for explosive nonlinear price action. And consider India. India became the world's largest importer of refined silver in 2025, with imports estimated at approximately $9.2 billion, a 44% increase over 2024, even at sharply higher prices. Indian investors and households were not deterred by rising prices. They accelerated purchases. Silver prices in India nearly tripled in rupee terms over the course of 2025, from around 80,000 rupees per kilogram early in the year to above 2.43 lakh rupees per kilogram by January 2026. India's demand is cultural, it is monetary, it is generational, and it does not go away. Now, let me talk to you about the emerging central bank dimension, because this is the next major catalyst that very few people are positioning for. For 70 years, the rule was simple: central banks buy gold, not silver. Between 2020 and 2025, global central banks bought more than 1,000 tons of gold per year, demonstrating an enormous institutional push toward hard asset reserves. Silver received essentially none of that central bank interest. But that logic is beginning to crack. Under Western financial sanctions, certain central banks have begun exploring silver as a monetary and strategic reserve that can withstand geopolitical pressure. China's reclassification of silver as a strategic material is part of the same de-dollarization momentum. When central banks, even a handful of them, begin allocating even small percentages of their reserve assets to silver, they will be competing for physical metal in a market that is already running structural deficits. The price implications of that are staggering. Here is the thing about the paper silver market that every stacker needs to understand. The COMEX futures market, the primary venue where silver is priced, trades paper contracts representing vastly more silver than physically exists in deliverable form. The ratio of paper silver to physical silver in existence has historically been in the range of hundreds to one. When physical delivery demands spike, when people and institutions actually want the metal and not a paper promise, the paper pricing mechanism breaks down. We saw signs of exactly this stress throughout 2025 and into 2026, with lease rates spiking, inventories draining, and physical silver trading at significant premiums to paper silver prices in certain markets. This is not a conspiracy theory. This is a documented market structure that has existed for decades and that becomes most visible during periods of stress. Every time this structure is tested, it resolves in higher physical silver prices. When paper claims on silver exceed the physical reality by orders of magnitude, and when physical scarcity becomes real and undeniable, the paper price must eventually converge with the physical reality violently and rapidly. So what does all of this mean for you right now? What do you actually do with this information? Let me be direct, because this is not a time for vague generalities. First, if you do not yet hold physical silver, the time to start is not tomorrow. It is today. Not paper silver, not a silver ETF, not a silver futures contract. Physical silver, coins, bars, metal that you can hold in your hands, that you can store in a secure location, that exists in the real world, independent of any financial institution's promise or any counterparty's solvency. The counterparty risk in today's financial system is enormous and growing. the derivatives, the leverage, the interconnected balance sheets of the global banking system. When this system undergoes its next major stress event, you want to be holding assets that carry zero counterparty risk. Physical silver is one of the very few assets on the planet that fits that description completely. Second, understand the form of silver you are buying. For stackers who are accumulating for a monetary transition scenario, a world where the financial system is forced to revalue or restructure, recognizable forms of silver matter enormously. Government-minted coins like the American Silver Eagle, the Canadian Maple Leaf, the Austrian Philharmonic, these are universally recognized, universally accepted, universally liquid. Pre-1965 United States silver coins, sometimes called junk silver, contain 90% silver content and represent historic recognizable monetary metal with the face value of the United States government stamped on them. In a transition scenario, this kind of monetary silver could be extraordinarily valuable precisely because it was previously used as money and is immediately recognizable as such. 1-ounce silver rounds from reputable private mints are cost-effective for building weight quickly. 1-kilogram bars and 100-ounce bars are efficient for larger storage. Build your stack across multiple forms. Third, understand the premium structure and what it tells you about physical market tightness. When you buy a silver American Eagle coin today, you are paying a premium over the spot price of silver. That premium has historically ranged from 10 to 20% above spot for government coins. When physical market stress intensifies, those premiums expand dramatically, sometimes to 40% or even higher above spot. The fact that premiums are where they are today is itself a market signal. In a genuine physical squeeze, you may not be able to acquire silver at any reasonable premium. Inventory simply disappears from dealers and mints cannot keep up. The lesson is clear: accumulate before the squeeze, not during it. Fourth, think about storage intelligently. Do not store all of your physical silver in one location. Diversify your storage across a home safe, a professional vault or safety deposit box, and potentially a segregated allocated storage facility at a reputable precious metals custodian. Know the difference between allocated storage, where specific bars or coins are registered to you, and unallocated storage, where you hold a claim on the pool. In a systemic stress scenario, only allocated physical storage provides genuine protection, and critically, hold a meaningful portion of your silver personally in your own possession, in your own hands. What you can hold, no one can confiscate, freeze, or rehypothecate. Fifth, think about silver miners and royalty companies as a leverage play on the silver price, but understand the risks involved. Silver mining stocks historically move at 2 to 3 times the percentage of the silver price itself when silver is in a bull market. A silver royalty company, which finances mines in exchange for a royalty stream on future production, offers exposure to rising silver prices with lower operational risk than owning individual mining stocks. But these are equity instruments. That carry management risk, geopolitical risk, regulatory risk, and all the normal risks of stock ownership. They should not replace physical silver in your portfolio. They are an addition for those who want leveraged exposure and who understand the additional risk they are taking on. Sixth, position sizing. How much silver is enough? Every individual situation is different. But consider this: throughout history, in every documented period of monetary transition or currency crisis, commodities and hard assets represented far higher percentages of total wealth than they do in today's portfolio. Today, the average financial advisor recommends 0 to 5% in precious metals. Historically, in periods of monetary stress, people who held 10, 15, 20% of their wealth in physical precious metals were protected in ways that those who held none were not. You need to decide for yourself, in consultation with your own financial reality, what the appropriate level is for you. but the data says most people are dramatically underweight in this asset class relative to the risks that are present in today's monetary environment. Seventh, stop waiting for a price correction to buy. This is the single most common mistake I see stackers make. They buy some silver, watch the price go up, wish they had bought more, then wait for a correction to add. The correction comes, and instead of buying, they get scared and wait for more confirmation. And then the price surges again, and they miss the add. The pattern repeats endlessly. The correct approach is systematic accumulation, buying a consistent amount on a consistent schedule, regardless of short-term price moves. This is dollar cost averaging, and it is the most psychologically and mathematically sound approach for an asset that you believe will be significantly higher in value over the next 3 to 7 years. You are not trying to pick the perfect entry point. You are building a position in an asset with extraordinary long-term fundamentals. The $10 difference in price today will be irrelevant when silver is at $200 or $300 per ounce. 8. Educate everyone around you, your family, your close friends, the people you love, not in a way that creates panic or sounds extreme, but in a grounded, data-driven, calm, factual way. Share the supply deficit numbers, share the industrial demand story, share the monetary history, share the gold to silver ratio analysis. Help the people in your life understand that what is happening with silver right now is not a speculative mania. It is a fundamental repricing of an asset that has been suppressed by paper markets and ignored by mainstream finance for decades, and that repricing process has real, documented mathematical foundations in supply and demand reality. They deserve to know this information. They deserve the opportunity to protect themselves. Let me close with this, because it is the most important point of everything I have said today. The financial system that most people have trusted their entire lives, the system of fiat currency, of government bonds, of bank deposits, of paper promises, that system is under the most severe stress it has been under since 1971 and arguably since 1944. The cumulative debt levels of the world's major governments are at historic records. The Federal Reserve is under political pressure unlike anything in its modern history. De-dollarization is not a fringe theory. It is an active geopolitical process being pursued by multiple major nations simultaneously. Currency purchasing power is being eroded in real time for hundreds of millions of people across the world. In this environment, in this specific documented data-supported environment, silver is not just an investment. Silver is insurance. Silver is a hedge against the failure of the systems that people have been told are unbreakable. Silver is 5,000 years of monetary history telling you through the price action of right now that something fundamental is shifting. 820 million ounces of cumulative deficit. China restricting exports. London inventories critically depleted, the gold to silver ratio still at 57-1 with historical norms at 15-1, industrial demand for solar, EVs, and AI accelerating every single year with no signs of reversal, mine supply structurally incapable of responding, JP Morgan projecting silver to average $81 per ounce in 2026, gold targeting $5,000 to $8,000 per ounce, a world in monetary transition, looking for hard assets and real stores of value. Silver is at the intersection of all of these forces simultaneously. This is not a coincidence. This is convergence. And for those who are paying attention, for those who have the courage to act on data rather than consensus, this is the opportunity that comes once, maybe twice in a lifetime. The only question is whether you will be positioned before the world figures it out or whether you will be watching it happen from the sidelines. Stack accordingly.